Today is a big one. Today we're going to finish analyzing the Morningstar Style Box for the value sector, and then we're going to wrap it all up together, see what would happen if we were to invest with that particular style, and if that information that we're getting from the style box is actually accurate. But before that, we're going to finish analyzing the data that the box is made of. And to see that, we're going to analyze what investing into price to cash flow will do to your portfolio. Stick around because this is a big one. I'm Alberto, and my goal is to find the best investment strategy using data, backtest, and of course, a little bit of my own experience. So if you are ready to Jindex, welcome to Just Press the Door. Okay, let's jump in. So first of all, we're going to talk about value as the investment factor. We're going to finish up and wrap up the Morningstar investment value approach. And then also we're going to dive in what is the value of the information we receive as an investor. And we're going to see very soon why that affects us in the way we think about things. So first of all, what's value? Obviously, value is what we think is the value of the company we're trying to buy, how much is worth it, but also it can be considered an investment strategy. Or when someone says value, we can understand that is the approach that this person have to investing, and therefore this person buy companies. They have a very good ratio in between the price and the value itself of the companies it buys. And of course, value is an investing factor, meaning that when you buy companies that have a very low price compared to some fundamentals we choose, then we're exposing ourselves to higher expected returns. How we calculate it and how we use it, that's a fully different story. And for this mini-series, we've been using the Morningstar Style Box and point of data they choose in order to create that box, which are this on the screen right now. The reason why we choose to start with Morningstar Style Box is because we need to start somewhere, but also, most importantly, this little box that you see on the screen right now is created by a company that has $300 billion under management, and yet they call them analysis company, not an investment company for some reason. But also this little box is present in pretty much every bigger institution that creates ETFs, and therefore informs the decision of most of the investors out there. Every single time someone wants to buy an ETF, there's a very big chance they are exposed to this box in order to make the decision on what they're buying and why. And this is Vanguard. You can find it on Fidelity. Of course, Morningstar uses the same. And this is another example of the box into action. Now, so today's goal is to wrap up the box. So we're gonna go out and find out what is the returns that we would have if we actually were to invest in value using the price to cash flow, which is the last point of data that we need to check. And after that, we're gonna check the box as a whole. Today's Jindex. In order to check the price to cash flow, we're going to create a Jindex, and a Jindex is nothing else but an index that is created DIY, is created to be investable for yourself based on your own goals. We did use a lot of this in the previous video, and the Jindex we're going to use today is based, of course, on the price to cash flow. We're going to order all the universe of stocks that are available. We're going to flip it around where in the green area we got value, and the top 10% are growth stocks. For the test today, we're going to use a global universe, a selection based on price to cash flow. Every decile contains the same amount of stocks. We said that the number of stocks that will be invested from each decile is 50, and we're going to rebalance every 6 months. We're going to use a time frame 2009 to present. That is not correct. We're going to use a time frame 2000 to present, and of course we're going to iterate 5 times for each decile in order to weed out any outliers, and that will skew our performance. And of course, as always, you can replicate this experiment at home. The code is in the description. So before playing the experiment before your eyes, here's what we're expecting. The first decile exposes the most to the value factor, and therefore we expect, if the value factor is a good factor to outperform. Mind you that we already know that the value factor is a good investing factor, and then we expecting higher returns to it. So what is actually happening today, we are testing if price to cash flow is actually a good way to measure value, and that exposes us to the value factor, and that is good enough to expose us to the factor value. The fifth decile is a control group. We expect it to sit in the middle of the results. And the 10th decile, we expect it to underperform because you shouldn't be able to get any exposure to the value factor with these kind of stocks. And therefore, if everything goes all right, we expect that to underperform. Random is just our control group. We're going to play it now, and let's see what happens. Well, I guess the results speak for itself. First decile is outperforming, and also you can see how random and fifth decile are very close together, indicating no exposure to any factor there. 10th decile underperforming, indicating negative exposure to the factor. But if you want to understand even better what's happening, we can see the data on this chart. And that's slope, left to right, left being first decile, top exposure to the factor, and 10th decile on the right, negative exposure to the factor. And that slope you see in the middle, that is 100% a sign that value is obviously a good factor that have higher expected returns, but also price to cash flow is a good data point that informs us if we are actually exposed to the factor itself. And you can see the returns are pretty phenomenal, but, and this is something you don't see from this chart, the volatility is extremely high when you use price to cash flow. And you can see how the volatility is 36%. And I'm going to push on this a little bit more. In fact, this is the returns you would have expected in the last 25 years, investing in value, using the price to cash flow to inform your decisions. But what you really don't see in this chart are the drawdowns. 2008, 2016, 2020 with COVID, those points, the drawdowns would be higher than 60%. Yes, overall, you would have a great return after that, but there's moments where as an investor, you see your portfolio dropping more than 60%, even more than 40% would just be enough to panic. And in the same time, it's not just your money disappearing, or at least the value of your portfolio dropping. It's not just that, it's the environment you sit in. 2008, 2020, you will have the entire world around you telling you that this is not recoverable. You would have 2008 with banks were failing, everyone was panicking, the Fed was dropping rates very fast, and everything around you was like geared to tell you that this is not recoverable and this is the end of the economy as we knew it. Of course, that didn't happen, but that is the narrative around you. And your portfolio will still take years before it actually recovers out of it, because the full recovery would be around 2009. Same with 2020. In this particular chart, the drop starts in 2018, and you would have 2018, 19, and 2020 until COVID happens, where your portfolio is dropping in around you. No one knows what is going to happen. Everything is closed. The economy is not existing anymore. And of course, the news are very, very negative all around you. And I'm pretty sure not many investors will survive that. So yes, good expected returns are very high, great. But as an investor, you need to understand that there's a limit to how much risk you can take, because eventually you will fail to follow your strategy. And that's what kills the investors. So for this reason, for this volatility, you can see price to cash flow to rank pretty low in the Jindex leaderboard. And that's all volatility, because the compounded annual growth rate is right there, is at 25%. It should be very high, but volatility is killing everything. If you want to see the rest of the Jindex leaderboard, it's much longer than that, but you can go and jump on justwithall.com leaderboard. So that's the first part of the video, but now this is where it gets interesting, because we have all the data to see if the information we're given by this box in terms of what value is actually correct and is working. If you've been following this channel, we've been through all of these information points in the same way we did with price to cash flow right now. And now we have the data to understand that if the information we're receiving is actually correct. And more than that, what does it mean for us? So let's start with forward PE. What you see is good returns. This is definitely somewhat exposing you to the value factor. But what is actually happening, you see the y-axis is very compressed. So you have the results from the first decile and the 10th decile to be very close to each other within a range of 5 to 6%. And that's okay. It's a good result to have a 19% returns. But compare this chart with this. See how using price to book ratio pushes that y-axis much higher, and the exposure to value through the selection of price to book is much more effective. You can see the returns top right go from 90% to 26% with a jump of 7%, which is more the return of the S&P 500 is in the last half a century. So this selection matters, and you can see already how the 12% weight of price to book ratio compared to the 50% weight over price to projected earnings makes absolutely no sense. Okay, we're going to go to the next step. This is price to sales ratio, and we get a similar situation where we got a 26% return for the first decile. Even less. The spread is even bigger right now if you're not exposing yourself to value through price to sales, and you actually go on the other direction where the 10th decile is. That's an exposure. That's an expected return of around 5 to 6%, which is incredibly low. So that tells us the price to sales ratio is a very strong indicator of exposure to value, and it should be taken in consideration. Again, though, the weights in our box is only 12.5%, which is insane in my opinion. Similar situation with returns price to cash flow, but then we saw how that brings a lot of volatility in, and that probably jeopardizes the overall results of your portfolio. So having price to cash flow at the same level at 12.5% compared to price to sell or price to book that had a very low volatility, that doesn't make much sense to me, but here we are. And finally, this is the biggest blow to the investor, dividend yield. We have a full video where we analyze all the data, and eventually what we got is nothing. Dividend yield is not a factor. Dividend yield will actually jeopardize your returns if you were to invest with company with higher yield. And there's a full video on it. We went through all the data. You will lose money, or at least you will have a lower expected return if you invest in company that have higher dividend yield. And this is the result of that research. So you expect a 10% return compared to 20-25 that you see above in the same chart. So this is the result now. Change the perspective towards what Morningstar may be thinking, and that is we need to sell bigger ETFs. And we have 2 videos already on that explains how ETF may or may not be the best investment tool for your investment career. Now, I created the Jindex that reflects exactly what Morningstar does with the weights and the selection process, and this is the result. You can see how the box better tracks the S&P 500 with a higher volatility. The problem is that charts like this and misinformation like this will then drip down to other provider of information that uses it as a selection tool, uses the same style as a selection tool for their value, and this is what you get to see. This is the information that starts spreading. The information being in the last 20 years, the last 40 years, value did underperform the rest of the market. And again, this is S&P. You can see the Russell promoting the same idea. And the result of this is people that actually believe that value is underperforming. And therefore, you get people moving their money from value, which is an actual factor that works, to growth, which is actually a negative factor. And we already saw it in this mini series, but we're going to see it even better when we're going to get a dedicated growth mini series. And maybe the narrative will be completely different if we were to actually look at what each one of these components do and actually use them accordingly. Because the bottom right there, the blue one, that's the S&P 500. And if you look above it, like wildly above it. Now, I selected 2010 to 2025 just because the S&P 500 had the best run in centuries. And that's where it ranks if you actually invest in value, right? Price to book, price to cash flow, price to sales. So where does that leave us? First of all, we are getting the message quite clear on this channel. You cannot rely on the messages and the information that you get from what we call the cash cartel. And the reason for this is that their own incentives does not align with ours. And second, this is very important, we need to start thinking out with our own head when it comes to investing. What I'm seeing over and over again, people are repeating things that hear over and over again without testing it themselves, and that makes them true. Like, this is unfortunately a society where everyone has a social media account, and if enough people repeat the same thing, it becomes true. Look at conspiracy theories, right? Enough people repeating it makes it true to the rest of the world. And unfortunately, not all the information that we're getting is true. Is actually someone who said it, especially in a situation of power, of influence, someone from a bank, someone from Morningstar, someone that has big institutional money behind them, some Ray Dalios, right? They will say things, and those things will be repeated by the media. Those things will be repeated by the people, and therefore eventually they will become true without people checking. And now we have stories like value has been underperforming for the last 15 years, where the truth is that value has been misrepresented for the last 25 years or more. I hope you enjoyed this video. Next week is going to be a big one. We're going to dive into what analysts are predicting and if that is something that we could rely upon. And if that's something you're interested in, please subscribe to the channel. I'm Alberto, and as always, my goal is to find the best investment strategy out there using data, backtest, and my own experience. You are on Jasper's Door.